Hello everyone and welcome. Myself Gokul. I am working as an assistant professor in the Department of Master of Business Administration in Sri Muthukumaran Institute of Technology. In this video, I am going to cover the financial management subject, which will come under the regulation 2025 and subject code was MB25201. In this video, I will cover the Unit 1 as a part 1. Uh, we will explore the foundation of the financial management in this video. Let's get started. Let's begin with the introduction. Financial management means planning, organizing, directing, and controlling the financial activities of an enterprise. This includes the procurement and utilization of funds. In simple terms, it is the application of general management principle to the financial resource of the organization. Now, let's look at a formal definition according to Weston and Brigham. Financial management is an area of financial decision making that harmonizes individual motives and enterprise goals. This means it aligns the interest of individuals, such as investors and managers, with the overall objectives of the company. Next, we move to the objectives of financial management. There are three key objectives, and first one was profit maximization, second is wealth maximization, third value creation. First we will see about the profit maximization. This is the traditional approach focusing on increasing earnings per share or EPS. Second, wealth maximization. This is the modern approach which emphasizes increasing the market value of the firm's share. Third and the last one objective was value creation. This goes a step further by considering both risk and the time value of money, ensuring sustainable long-term growth. Next, we can see about the scope of financial management. In fact, financial management is considered the most important functional area of management. The scope of financial management is quite broad. According to Dr. S.C. Saxena, the scope was summarized in 5 A's. First A was anticipation, and 2 acquisition, and 3 allocation, and fourth A appropriation, and last fifth A assessment. First we can see about the anticipation, which means estimating the financial needs of the company, and acquisition means collecting finance from different sources. Allocation means using finance to purchase fixed assets and current assets. Appropriation, dividing profit among stakeholders and keeping part as reserves. Reserves means they will keep the profit as a part, which will be used for the upcoming businesses, which means they will not issue the dividend to the shareholders. They will hold the dividend like a reserve, or they will hold some other profit like a reserve, so that it will be used for the upcoming business expenses. Then last, assessment, controlling all financial activities of the company. Finally, let's discuss the functions of financial management. These are the core activities that a financial manager performs. First one was estimating the amount of capital required, determining capital structure, choice of sources of funds, procurement of funds, utilization of fund, disposal of profit or surplus, management of cash, financial control. Let's see elaborate of each function. First, estimating the amount of capital required. Business firm need capital for three main purposes: purchase of fixed asset like machinery, buildings, and meeting working capital requirements for day-to-day operations. And number three, modernization and expansion of business. The financial manager must estimate both short-term and long-term fund requirement to ensure smooth business operation. Then second one is determining capital structure. Once the capital requirement is estimated, the next step is determining capital structure. This involves deciding the kind and proportion of various sources of funds. The finance manager must determine the proper mix of equity and debt, short term and long term debt. The goal is to achieve the minimum cost of capital and maximize shareholders' wealth. The third function is the choice of sources of funds. Uh, Before actually raising funds, the finance manager must decide where to get the funds from. Possible sources includes equity shareholders, preference shareholders, debenture holders, banks and financial institution, public deposit and others. Each source has its own cost and implication which must be carefully evaluated. The fourth function is procurement of funds. Here the finance manager takes active steps to raise the required funds. This may involve negotiating with creditors and financial institution, issuing a prospectus for public issue. The procurement process depends not only on cost but also on market conditions, choice of investors, and government policies. The fifth function is utilization of funds. After raising funds, they must be invested wisely in various assets to maximize return on investment. While making investment decision, the manager must consider three key principles. Uh, First principle was safety of the investment, probability, and liquidity. The sixth function is disposal of profit or surplus. The finance manager must decide how much profit to retain for reinvestment and how much profit to distribute as this dividend. Factors influencing this decision include the trend of company earnings, market price of shares, future fund requirement for financing growth. The seventh function is management of cash. Managing cash and other current asset is crucial for day-to-day operation. It involves forecasting cash inflows and outflows, ensuring there is neither shortage nor surplus of cash, maintaining sufficient funds for materials, wages, and daily expenses. The eighth and final function is financial control. This involves evaluating financial performance to ensure goals are met. The overall measure is return on investment. Other control technique includes budgetary control, cost control, internal audit, break-even analysis, and ratio analysis. The finance manager must emphasize both financial planning and ongoing control. Each of these functions plays a vital role in ensuring the financial health and efficiency of an organization. In this part, we covered the meaning, definition of financial management, its objectives, its wide scope through the 5 A's, and the essential functions that drive financial decision making. In the next session, we will dive deeper into financial planning, capital structure, and more. If you found this helpful, please like this video, share it with your peers, and subscribe for more lessons. Feel free to ask your questions in the comments below. Thank you for watching.